Hello, everyone. You're listening to the LockInYourSuccess.com Trading Performance Podcast with Master Trading Performance Coach John Locke, where it's all about real traders, real problems, and real coaching. This is episode number 34, and in this episode, I'd like to share with you an excerpt from a presentation I did for the traders at Aramere Corporation about an extremely important skill that is required in order for you to become a tremendously successful trader. And that skill is the ability to properly interpret your trading results and to properly understand the dynamics of your trading strategies. Listen in and enjoy.
What I want to do is I want to show you something really quickly here. So this is a bull trade, and I'm just going to ask a couple of questions about this. We talked about losing scenario in this, right? Just so everybody knows, this just happens to be a 7 lot. We took in about $2,000 of credit. We're going to have a maximum loss of about $2,000. We do 1-to-1, and there's no adjustments. So basically, if the market comes down to, and we'll just take out implied volatility, right? If the market comes down to about 1440, then this trade is going to max loss out. We have another trading strategy known as a Super Bull, which we do on the SPX, but here, let's see, I'll probably do 2 contracts. But here is what that looks like. So we have a market at 1552, and we have a vertical here, and we'll just do a call vertical with the long at 1560 and at 1580. And I ask people a lot of times, which trade has higher probability? And if you want to answer, you can. But which trade has higher probability? Which one's more likely to win? And what they'll tell me is they'll say, well, you know, this is a 10 delta. Well, first of all, these both have the same profit potential, right? They both have the same maximum loss, which is like right around $2,000. Consider that I can lose a lot more than my maximum loss on this trade because what we call the structural risk in the trade in a bull trade is much larger than a Super Bull. In other words, the market might come down to, I don't know, 1445, right below my maximum loss. It might gap down. Well, what's the Russell gapping now? 50 points the next day. And next thing you know, I'm down $4,000 on the strategy. Certainly happen, right? That can't happen on this one. That can't happen because the market could literally go to zero and I only lose about $2,000. So this one this bull trade has a stop out point. This one does not. I could also make about the same amount of money if the market goes up. Okay. Most people would say that this is a 10 delta, and this applies for condors and all this other stuff too, right? They might say, well, we'll just estimate this as a 10 delta short strike. And you'll hear people say, well, this has a 90% probability of winning. That's complete bullshit because you can't let the market go down to here, right? Not only that, it's probability of touching. It's not probability, right? If you touch that, you have to stop, say that was your stop out point. If you touch that and you had a stop out point at the short strike, for example, then the probability of touching that is much higher than 10% statistically. Okay, the actual stop out point here is going to be somewhere around here. What's the delta of the option at 1440, which is a more realistic point? It's actually closer to what, 27%? So if we're looking at that number, now this only has maybe like a, I don't know, 70% chance if we take the expiration in the money theory that most people say from trading, right? It only has so it's got a much less chance of winning, maybe 70%. And if you take a look at probability of touching, which is going to be much higher, the probability of touching that point is even higher than that. So that puts you down to maybe a 60% probability of a win for the strategy. Now, it is true that you are going to gain a little bit more distance as time goes by, okay? But it's still, my point being, the probability of you winning this, at least the statistical probability, is actually much lower. The actual probability of this, effectively, by the way, if you traded this from 2002 till today, this wins 75% of the time, almost exactly. Okay, so that's the actual probability of this strategy winning with that stop out point, and the way the market's been in the last 20 years, about 20 years. You take a look at this strategy, people will tell you that this is a very low probability strategy. And if you're using the delta, that means it's got, what, a 55% chance of failing? Okay. The good part about this strategy is that, again, we do nothing here, right? There's no adjustments. The good part about this strategy is I cannot lose more than what I expect to lose, because my structural risk in the position isn't 27 or isn't almost $20,000 like this one. My actual structural risk is my maximum loss. That means that the market can go down forever, and I don't have to stop out of the trade. Meaning that if the market goes down a lot and then it comes back up, which I know never happens, right? It happens quite often in historically, then this strategy doesn't stop out, and it may even win. So my question in one strategy, so in the regular bull strategy, or this blue strategy, is the market going to go down enough to stop me out for the duration of the trade? Where the question in my other strategy is going to be, in 65 days from today, at some point, is the market likely to be higher than it is now, or higher than 1572? The effective probability historically from 2002 forward on our Super Bowl trade is actually 86% win rate. This strategy actually has an 86% win rate historically. Actually, I can go back to 2011. So let me just go to, I got to go to reports, right? So if I go to reports and I go to account for our Super Bowl from 2011 forward, and I go to our charts here, this strategy has a win rate of 87%. This is a simple strategy. You put it on, you take it off. That's it. Win rate of 87%. That's insane. And I believe it's over 85% all the way back to 2002. It is, now I'm not trying to sell a strategy, right? This is something free we offer in our FIT program, but I'm just trying to show you the difference, that the actual bull trade from 2002 forward is about 75%. It has a lower win rate, at least historically. We don't know what's going to happen in the future. It has a lower win rate than the Super Bowl, which theoretically, from what a lot of people say, actually has this is supposed to only have a 40% chance of winning or something like that, right? So what a lot of people tell you, and a lot of the assumptions that people make as it revolves around income trading, is completely wrong. And if you go by those assumptions and you go by that type of a thing, then a lot of times you're making the wrong choices because your assumptions aren't there. So if you understand the dynamics of the strategy, and you understand that most of the time, 2 months from now, or a vast majority of the time, I would say 86% of the time, or 87% of the time, 2 months from your entry date, you're going to be at a higher level than you are today in the marketplace. If you go by that assumption, then this trading strategy is something that's good for you. But in either strategy, you should understand that, or let me just point this out. This strategy historically does fantastic, But you shouldn't just go by the back testing results and say, I'm going to take that strategy and I'm going to trade it every month now going forward, because that strategy has a losing scenario. And it has a scenario where you will have multiple losing trades, possibly for months or years of losing trades. For example, if the market goes in, if the market situation changes to the context where it's no longer uptrending over the longer term, and we're getting a year or two years of downtrending, where the market two months from today is lower than it is. If we go an extended period of time like that, this strategy is going to get murdered. So as a trader, you could trade this strategy pretty much what most people would call it non-subjectively. And if you did that for the last, I don't know, 10, 15 years, you'd have done fantastically well. That has nothing to do with whether this strategy is going to do well going forward. But if you understand the dynamics in the marketplace that are allowing this to play out, and what has to change in those dynamics for this to continue to play out, or for this to turn into a long-term loser, then you can do things a little bit differently. If I were to share the results from this year so far, this Super Bowl, like I said, is actually up 240-something% on our planned capital. Of course, you can't trade at full size because you're taking a full loss, right? You can't trade at full size because you're losing everything you have in the trade. So you have to limit your size. I trade at 1/10 the size I would trade a normal bull trade. That way, 10 losses equals 10 losses in the other trade, right? It's from an account perspective. So you'd have to kick those numbers down. It's really more like 24% if you're actually doing a reasonable size. But still, a fantastic strategy here. As far as performance this year, that was 249. This bull vertical lost money this year. But you say, John, the market was up. The market was bullish this year, except for 2 months. And I would agree with you. The market's been extremely bullish this year. It was bullish early on coming in, and it's been bullish since March, extremely bullish. But the problem is, one of the problems with this blue strategy is that it has a stop out point. And that stop out point keeps getting triggered because the average true range or the cycles are too big. And the entry timing happened to be whenever we entered the trade, or not whenever we entered the trade, but a lot of times when we entered the trade this year, we were at a point where we got a 100 or 200 point down move in the Russell, stopped me out, and then the Russell returns and then ends up being higher by the end of the cycle. Very, very frustrating, right? But also very, very predictable. It doesn't take a genius to see that we're getting these huge down moves or in the middle of our crazy uptrend that we've been in. That is going to stop out that bull trade. It's not going to bother the Super Bowl trade. It doesn't bother at all because I can get my 200 point drop all the way down to here and then have the market be back up here 2 months from now. And bam, there you go. This strategy's only lost one trade. This Super Bowl strategy's only lost one trade for the year. The rest of them have been up. We don't know what December is like yet because we haven't closed in December, but it's looking okay so far, right? This other one's had a lot harder time. And the reason is because of the dynamics of the strategy. So this is something really to think about, because what a lot of people believe and what a lot of people are taught about these types of strategies, just looking at the bull trade, I would imagine that some of you are surprised that strategy, that Super Bowl, has that kind of a win rate. And you'd be equally as surprised to take a look at what a lot of people are trading right now and the assumptions they make with their butterflies and broken wing butterflies and calendars, especially, my God, calendars. Don't even get into that. But they make these assumptions about these strategies, and the assumptions are completely, like, they're way off base. And that can lead to confusion and so forth and things like that. So I was just pointing that out. Learn to quickly evaluate any trading strategy. It's a very important thing to do if you want to become a truly confident trader. You don't want to use back testing and recent results as confidence for your trading, because when you do that, I'll go through what happens. I back test a strategy forever. I forfeit it to the market or whatever, and I prove to myself this strategy is going to work now and or into the future. Well, actually, I'm not quite convinced. So I'm going to try this strategy with some money, right? So I'm going to try this strategy. I try it with a small amount of money. And of course, if it fails, oh, that strategy is really crap. I'm going to go do something else. That's actually the best thing that could probably happen to you if that's your mindset, by the way. If the strategy does well, I'm going to trade it a little longer and see if it still does well. If the strategy continues to do well, I'm going to add money to it. A lot of times people will double their size. If they happen to hit that strategy where it gets a 6, 8 month or a year and a half winning streak, which happens, right? We're in high probability strategies. They win 80% of the time. If I happen to hit that cycle or get into that cycle where I've won 80% of the time, what do? I scale up like crazy. Why? Because I'm basing my confidence off backtesting results, and I'm basing it off my recent results that I happen to be getting in the strategy. Even though backtesting results are form-fitted, I don't give a crap what trade it is. If you fine-tune your strategy, it's form-fitted. Recent trading results are highly dependent on luck. So now you have a form-fitted strategy that you've built your confidence on, and then you've increased your confidence through random lucky results, and you're trading this huge size. Now, even if the trade does have an 80% win rate, which is very possible, right? We have strategies with 80% win rates. We just showed you one. So it's very possible. So I'm trading this trading strategy that now I've kind of dismissed the possibility that I can lose, because now I'm overconfident in the wrong things, by the way, on the luck on the luck of the draw that I've gotten over the last 6 months or a year. I'm oversized, and then the normal thing plays out. I get one of those normal losses. Then maybe it's an extra hard hit, right? Maybe I take 1.5 times maximum loss because maybe the market's, it's been so favorable for a while. Sometimes when it breaks, it gets kind of nasty, right? So now I take my 1.5 times maximum loss on a big trading size, and now I say, oh, look, I've traded for the last 16 months. I've traded this strategy, and I lost money. And you go back, and if you looked at this from a percentage standpoint, right, you made, I don't know, 10%, 10%, 10%, 10%, 10%. You had a loss, you lost 15% because it was a 1.5 maximum loss, to say. Or maybe you're making 5%, 5%, 5%, and you lost 15%. Still, good return over maybe that period of a year from a percentage standpoint, but now you've lost money because you started trading with $10 and now you're trading with $1,000, and you've been making 5% of $10, 5% of $20, 5% of $100, 5% of $200, and then now 15% of $1,000, and now you're down money for the year. Nothing went wrong, by the way, with the strategy, right? This trading strategy sucks. I've been trading it for a year and lost money. Your confidence is shot from a completely normal situation, meaning that what are you going to do? Well, I'm going to reduce size, right? So you go back and you start trading small again, or you switch to another strategy, and you do that same process over again. And this is what keeps traders in this loop for, decades of trying to make money trading and not really getting anywhere. It's because they're just constantly going through that process. And what we try to do is we try to break that process, and not having people rely on recent trading results and back testing for confidence, but have them rely on self-confidence or confidence in themselves that they understand the strategy, they understand how it's interacting with the marketplace. Because when you do that, if I'm trading this strategy and I'm trading it because it looks like it interacts with the marketplace, and then the marketplace shifts during my trade, which happens, and I lose that strategy, we both lost, right? You lost because you lost and I lost, but your confidence is shattered because now the strategy, you don't understand why really the strategy lost. That's a shock to you. You weren't thinking about it losing, right? And you don't really know what to do because, what if it loses again? And what if the market's changed now and this strategy isn't profitable anymore? All these questions come up and the confidence just gets blown apart, and you're not willing to go into the next trade. Where if I completely understand what's going on here, I have this strategy, oh, the market shifted, I lost a trade. I'm like, oh, okay. So my question becomes, is the market environment, has it changed in a way where this strategy is going to be problematic trading? If it hasn't, in other words, it may be just a short event, and it's just just a blip on the radar, you can continue on going on that strategy. Or I can say, yes, I believe the market this is a change for the marketplace, right? This is a difference, and then I can apply a strategy that I know will do well or modify my strategy in a way where I know it will do well in the market going forward. Right? Because you couldn't have back tested 2020. You couldn't have done that because it's never happened before. But if you understood the dynamics, you could have seen this coming. When we get the big down move with the range expansion, when we broke the major support level, right? Those were all warning signs. The market's changing. This type of strategy that may have been working fantastic in, the run up into January and February is no longer going to be viable for this type of market speed. And then I can say, well, what type of strategy is? So I may have been doing a bull trade. I mean, just take something simple, right? We don't have to get complicated. I could have been doing a bull trade into January and February. Would have been perfectly fine. Wouldn't have been an issue. I see that type of down move. I can swap over into a Super Bowl. Because I know that kind of volatility, even whether the market's up or down, isn't going to be any good for my bull trade anymore. Super Bowl, yeah, the market's going to be up in 2 months, but chances are this crash is going to alleviate itself at some point, right? So I can be taking a very well-defined risk, and I can trade my Super Bowl, and then I can do well the rest of the year when the market bottoms out and we recover. Because we all know when the market comes down really, really hard, most of the time, it's going to have a V-shaped recovery because the government's going to step in, something's going to happen, right? And it's going to shoot back up, which is pretty much what happened here. So those are just some things that we're talking about. Check out our Trader Transformation Workshop. It's really cool. You go over to lockingyoursuccess.com and you can do that, and check out these free resources, and hopefully they help you out.
And that is what I have for you today. I encourage you to visit us at lockingyoursuccess.com. That's LOCKE, inyoursuccess.com. And check out our pro membership so that you too can break through barriers and make quantum leaps in your trading and in your life. Thank you for joining me, and I look forward to seeing you on the next Trading Performance podcast.